Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Nanette Abuhoff Jacobson, Global Investment Strategist at Hartford Funds. We have Massud Ghaussy, Senior Analyst at Nasdaq Investor Relation Intelligence, Joyce and Madie Radner on the Nasdaq Market Intelligence desk. We are here to discuss what will remain top of mind for investors in the second half of the year. It is great to have everyone with us. Welcome to Trade Talks. And Nanette, I guess that's really what the question is, how we're thinking about fundamentals, whether it's inflation, the Fed, growth, international, domestic. It seems to be there's a lot packed going to the second half of the year.
Yeah, for sure. There is just so many things going on in terms of the economy, politics, of course, and monetary policy with the FOMC meeting coming up. And the fundamentals right now seem pretty good to us. Yes, growth is slowing down, but we're coming off really punchy levels. I mean, remember that fourth quarter growth was 4.9% and then 3.4% in the first quarter. So I think that, yeah, we're slowing, but it's a deceleration, not recession. So pretty actually supportive for equities. And the Fed is supportive. We're still at 5.5%, 5.25% rates. They've got a lot of room to move, and they've sort of signaled that they're ready to go. So there's that. It's just the politics that are inserting some volatility and uncertainty right now.
It's interesting though, despite the attempted assassination on Trump over the weekend, I feel like the market digested that relatively well. I mean, this was the former president of the United States, right? And that at any other time, I thought you would have expected a much more volatile reaction.
Yeah, no, it is interesting, and we've seen this even with the French elections, with the surprise result. Markets went crazy for a moment, and then they came right back with the results being a hung parliament. But I think the reason is that probably the markets are putting a higher probability of a Trump presidency. And for the market, that means less regulation. It means extending tax cuts. And so from a standpoint of market friendliness, it probably makes the market feel actually less, there's less uncertainty about the outcome and probably more certainty that it'll be market friendly.
I guess to Nanette's point on politics, over the weekend post-assassination attempt, I follow electionbettingodds.com, which is the pricing mechanism. Essentially aggregates pricing across 4 or 5 different platforms. So it's the best predictor of current events, much superior than polls. And 30 minutes after the assassination attempt, Trump's contract odds of winning the presidency shifted from 58% to 65%, and now currently around 68, 69%, which is actually pretty high. The odds of Senate takeover of GOP is now at 75%, whereas the Democrats 25%. And the House is currently around 55% in favor of GOP, which flipped. It used to be Democrats. So really, I think the markets are starting to digest a potential Trump presidency. I know it's a long way away. And having said that, over the last several election cycles, as per Bank of America and also Goldman reports, historically, volatility picks up. So expect some volatility going into November.
Right. I mean, also from a seasonal perspective, too, right? When you look at August and September, that's kind of the expectation. But to your point, if it was a split ticket, right, then it would be hard to get any sort of legislation through. But if it goes, towards one side or the other, that's when you start to be able to make policy formulations and figure out how this could impact different sectors. But I think another thing here, Madie, is that we're starting to see breadth broaden out and some participation from the small caps.
Yeah, I think last week's economic data really sparked a recent rotation into small caps as well as rate-sensitive sectors. So last week, the Russell 2000 closed up about 6%. It's continuing to climb this week. Russell Microcap was actually the best performing group last week. What's interesting is that 90% of Russell names are up today, same amount Russell Microcap, whereas this time last month, only about 60% of the names were up, vice versa. Looking at the S&P 500, that stands out to me a little bit more when we look at up and down names. But 320 names were down this time last year. Now about 72% of the index is up. So it looks like there's a broader participation within small caps as well as within the larger cap companies.
Right, and Brian, that's what the market has been looking for, right, is wider participation within this space. So let's pull up a couple of your charts when we look at equal weight when we look at breadth, where can you see from a technical perspective where that's improving?
Certainly. So the equal weight index broke out to new highs in March, as did the mid-cap index. And so to me, that was confirmation that breadth was getting better. The early breadth signals were from June 23, when the advanced decline line for the S&P 500 started to make new all-time highs. And so the advanced decline line for the S&P 500 has continued to make new highs. It's this week making new all-time highs again. The equal weight index this week and the mid-cap index this week, even though it wasn't making new highs in June, and that was one of the a couple of things that the cynics were pointing to saying, hey, there's no confirmation, there's signs of weakening breadth here. Performance of the equal weight, performance of the mid-caps, they're now both making all-time highs again. And so it's really been the Russell that's really been the drag as far as breadth goes, and that's now beginning to break out. As you can see, we're looking at the Russell 2000 here. It's breaking out from this 4-month consolidation pattern. And Russell was up 5% at the end of the first quarter. It wasn't like it was having a terrible start to the year. It certainly pulled back. I think it pulled back about 9.5% from those highs. But it wasn't dramatic. It wasn't like down more than 5% year to date at any point in time this year. So certainly the relative performance, which I think is different than breadth, has been quite drastic given the mega caps, particularly the Mag 7. But I think we've had pretty solid participation amongst a lot of companies. Certainly the small caps are an exception, but Maddie and I were talking about this off camera. In the 80s and 90s, from 83 to 99, 13 out of those 16 years, small caps underperform large caps. So you don't need small caps to outperform in a bull market in order to confirm a bull market.
Right.
So going back to Maddie's point, one concern I have is small caps and value may be catching up as a result of lower rates. What essentially we're doing is we're pulling future forwards to the present. This is based not off of earnings growth, but on actually easy money policy. So it's inflationary in nature, and I don't think that's sustainable in the long run. What we need is a sustained rally based on earnings growth, which we don't have with small caps. But I think this is where the politics dimension will come in, and if there's a GOP sweep, potential tax cuts and deregulation will usher in economic growth, and that will help the value and small cap stocks and all the other laggards.
Right. And
if I can just interject, I don't think it's just a small cap, and I would take your point that lower rates and you need earnings to really validate and sustain that move. But you've got other sectors where earnings growth is expected to increase. In fact, earnings growth for other sectors outside of IT are actually accelerating in 2025, whereas they're moderating for tech. So you see that spread between earnings growth expectations of the tech sector and the rest of the market actually starting to close that gap.
Right, and I think that's a great point that Massud had brought up, and sometimes these smaller cap names, they do trade lower than the market for a reason, right? So even when we're going into 2024, there was this expectation we were going to get 6 to 7 rate cuts, and we saw that rally at the end of the year. In my mind, the fact that we rallied off of fundamentals more than just rate cuts was positive for the market.
Yes.
If we were to get 6 to 7 in 1 year, there's a bigger issue, right? So it's like sometimes you have to be careful what you wish for when it comes to rate cuts and for what it signals for the broader economy.
Yes, and for sure, the reason or what's driving lower rates is super important. If we were, as you said, if there were 6 cuts, and look, the economy is slowing right now, and there's conversation now, actually recession has come back into the dialogue. So if recession really, if that probability goes up and we see weaker data, of course retail sales numbers did not indicate that at all, but if we did see weaker data, then lower rates for small caps would not be a good thing.
Right, right. I think sometimes the fundamentals do trump what we're seeing from a federal or geopolitical or just more of a macro perspective. But it's interesting, your note for the second half of the year, you are moderately overweight on global equities, but you're not specific to regions.
Yes.
What's the thesis behind that?
Yeah, it really is the broadening theme. We've absolutely seen U.S. overtake other regions in terms of performance, except for Japan. Japanese equities has been the stealth outperformer. It's done actually better than the S&P in local currency terms. But we are really saying that the environment in the global market, that the global cycle is okay. And so because of the extreme outperformance of U.S., we think the conditions for equities and risk is okay, and that will broaden out by sector and by region.
Yeah, so Brian, let's take a look at that for a moment here in emerging markets. If you can give us a technical view on what you're seeing in the charts and what seems to be attractive.
Yeah, I like the setup in the emerging markets ETF, EEM. It had a breakout in early spring, pulled back to its what was a prior 18-month resistance level here between 41.60 and 42.40, and then over the last 5 or 6 weeks, it's been rising higher, and now it's making 2-year highs. And that does include China. And if you look at the emerging market ETF ex China, that's actually close to its prior cycle highs from 2021. So China has been a drag on the EEM ETF. I don't know if you have thoughts about if Trump was to go, if Trump were to win the election, and there were increased tariffs, would that be a greater headwind for say for China? And maybe if you were an investor, you were emerging market focused, maybe you want to go EM ex China or not.
Right. Higher tariffs too could also impact smaller cap companies as well. I mean, the costs are certainly going to go up for their inputs. So perhaps the market has reacted in a way that wasn't as volatile as expected because they know what to expect from a Trump presidency. They know what to expect from a Biden administration. I get the sense, and I'm not a political commentator by any stretch, but it feels as if a Trump administration might look a little bit different than it did last time.
Absolutely. Back in 2016, I think there was a blueprint for a tax reform. There were conversations about deregulation, but this time around, it's been less about policy. And the markets have been kind of blind to the tariffs. It's more of the economic growth program that has come to the fore first, and the markets are starting to price that. So it's yet to be seen. I think there's a lot that markets are digesting. You also have earnings. You also have inflation. You also have the Fed. So there's a lot going on. I think it's a little premature to come to conclusions as to how the markets will perform over the next several months from my perspective.
Yeah, and off of that, I think some of the regulation-heavy groups like financials and healthcare have seen a little bit of movement based on the headlines that we've seen out there, but I think earnings is really at the forefront and more closer-term focus for investors.
Yeah, I do think I have a concern that the market may be a little complacent about the effects of some of the policies. 3 in particular, if we did have a Republican sweep that I'm thinking about are trade, as you said, 10% tariffs across the board, 60% on China. That could certainly be inflationary. It raises the prices, and there's a retaliation, obviously, from those countries that where tariffs have been imposed. Second, you've got the tax cuts being extended. The CBO themselves have estimated, they've revised their estimates to $4.6 trillion over 10 years, that would add to the deficit. That's a lot of Treasury supply that needs to fund that deficit. And third is immigration. And we don't know, how that's going to play out in terms of deportation or further restrictions. But we had a labor supply shock of additional immigrants, which would be reversed. And so that, if there's a smaller labor force, that could pressure wages higher. So there are offsets for sure on regulation and other parts of the market, but those are things that I'm thinking about that could be another inflationary force, not in the near term, but longer out.
Yeah, I just remember, the fourth quarter of 2018, December in particular, when we were starting to talk about those trade wars, we were quite where the administration thought perhaps interest rates should be. What, we get a 20% drawdown? Or I mean, it was a really volatile quarter, particularly the month of December. So to your point, I feel as if perhaps we're not, our short-term memory is probably taking over versus what we've seen historically from a Trump administration.
And I think that there's always the commentary that the market has a one-track mind, meaning they can only focus on one thing.
Which is why I'm surprised it digested the fact we didn't get 6 to 7 rate cuts this year.
Yes.
That's all it's been talking about for years at this point. So I thought, Brian, we discuss this all the time.
Yep.
The fact that it took more of a fundamental tact than just relying on Fed policy. I also think that fiscal policy is more important at this point anyway. But this was a fundamental move this year, I guess, for all intents and purposes.
Yeah, this cycle, cycles are often described as being credit driven, and this cycle I've been hearing more and more commentary saying it was income driven combined with fiscal spending, and maybe the two are related. And so the rising in rates maybe didn't create that recession that everyone was anticipating at the start of 2023. And so we've just seen the follow through of corporate earnings here in 2024. And so when we're talking about international markets and emerging markets, I'm also curious, what the impact of the new administration and things that you discussed. How that impact the dollar, because the dollar and emerging markets tend to be so inversely correlated. And so if we were to have a dramatic increase in spending, inflationary pressures, would that be good for overseas markets? So
right. Well, I mean, let's talk about credit for a moment here, Nanette. I feel like when we talk about liquidity, it's kind of thrown in this one basket, but there are different types of liquidity, one of that being credit to fuel this liquidity. What are your thoughts there? You know, economic growth, it's solid, not growing as much as it was, but I think that needs to be, you know, in the back of one's mind as well.
Yeah, I think the credit markets have done extremely well, whether you look at investment grade, high yield, bank loans, emerging markets debt, even with all the political risk, and countries obviously have different debt dynamics, but it's done really well. People are really enticed by 8% yields. And we've been in an environment where you can get 8% in high yield. So we think that that environment could, even though spreads themselves are very rich, that's sustainable because the technicals, people are really encouraged to get the income, have the carry. And the technical situation is a lot of the supply that's coming is being easily absorbed because it's refinancing actually higher rate risk, because we have come down from October levels. You know, we were almost at 5% yield, so we're substantially lower. So supply is lower, and in the high yield market, you have rising stars, and these are companies that have been upgraded to investment grade from junk. So that also has decreased.
So you're talking to issuers all day long. Is there a specific sector or a theme that they're either encouraged about or they think could be a challenge in the near term?
You know, it's an interesting market. I think investors are actually looking less at sectors and more at factors. We are in a bifurcated market, and the only factor that has been outperforming has been growth across various sectors. Just look at tech for example, just pivoting away and just looking at tech as an example. It's only a handful of tech companies that have been outperforming, whereas the rest of the tech space hasn't been outperforming. In fact, if you had a basket of growth tech, earnings growth tech, beginning of this year, and compare that to a basket of negative earnings tech, that portfolio had a negative 40% return. So it just goes to a 40% disparity.
Right.
So it just goes to show that looking at things from a sector perspective is a little tricky in this market. As a result, it's probably better to look from a factor perspective. And as a result, when we advise clients, issuers, to go out and target investors, we look at it more from a factor perspective than a sector perspective currently.
Right. And Madie, when you take a look at the IPO market, is there anything that you can discern in terms of how investors are thinking about risk or the health of the market for the remainder of the year?
Yeah, well, banks have started to report earnings, and based on some of that commentary, the investment banking revenue has been good, M&A has been strong, so we're hoping that the next step, the IPO market, will continue to grow and be strong. Actually, about a quarter of the IPOs in the first half of the year were considered unicorns, so companies who had a valuation above $1 billion. Looking at the pipeline, we have a few more to come, so it is looking like maybe companies have waited, and this is a good time, and their valuations are strong coming into the second half of the year.
Yeah, it's just so interesting, Nanette, you know, when you're thinking about 2020, 2021, 10 billion was kind of like the threshold for the unicorns, and just to see how the market has revalued itself, which I think is a good thing. We're coming back to fundamentals and not so much, you know, growth at all costs. I think that's encouraging, particularly once these companies go public and it reaches the investor at the end of the day.
Yes, and that could also be another catalyst for small cap performing, right? Because these are smaller companies that are being bought by, much larger, whether it's in the healthcare sector or other sectors, and so that would be another catalyst for small cap to perform well.
All right, we will leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.